Imagine this. You wake up in the morning, you grab your cup of coffee and check your phone. There's a notification from your investment app. It says you've earned some money overnight. You didn't sell any stocks, you didn't make a trade, but your balance went up. That's the beauty of dividends. Dividends are the quiet, reliable way that investors can earn money without lifting a finger. They might just be the best-kept secret in the world of investing. But what exactly are dividends and how do they work? Today I'm going to break it all down for you step by step. And by the end of this video, you'll understand how dividends can be one of the most powerful tools to build wealth. Let's start at the beginning. Picture a company. It could be Apple, Coca-Cola, or even a company you've never heard of. This company is in the business of making money. It sells products, provides services, and aims to grow year after year. As the company grows, it starts making a profit, which is basically the money left over after all expenses are paid. Now, the company has a decision to make. What should it do with that profit? Some of it might go back into the business. They might want to open new stores, hire more staff, or develop new products. But sometimes they have more money than they know what to do with. And this is where dividends come in. When a company decides to share a piece of its profit with its shareholders, they do that in the form of a dividend. Think of it like this. If you own shares in a company, you own a small part of that business. So when the business makes money, you get a piece of the pie. And that piece is called a dividend. So how do dividends work in practice? Let's break it down. Companies usually pay dividends on a regular schedule. This might be every 3 months or quarterly, like many companies in the US, but some companies pay dividends monthly and others might do it once a year. When a dividend is paid, it's often a small amount of money for each share you own. Let's say you own stock in a company and they decide to pay a dividend of $1 per share. If you own 10 shares, you'll receive $10 in dividends. If you own 100 shares, you'll receive $100. It's that simple. Now you might be thinking, well, $1 per share doesn't sound like much, but here's the key. Dividends add up over time, and the more shares you own, the more you can earn. Here's where things get interesting. A lot of companies don't just pay dividends, they grow their dividends over time. This is called dividend growth. Some companies make it a point to increase their dividend every single year. So even if you're only getting $1 per share today, that could turn into $1.50, $2, or even more down the road. Take a company like Coca-Cola. They've been paying dividends for over a century, and they've increased their dividend every year for more than 50 years. That's the power of dividend growth. Your income grows alongside the company's success. And here's something else. If you reinvest your dividends back into buying more shares, you start to see the magic of compounding. It's like earning interest on your interest. The more shares you own, the more dividends you receive. The more dividends you receive, the more shares you can buy. Over time, this snowball effect can really grow your wealth. So, why do companies pay dividends in the first place? Well, paying a dividend is a signal to investors that a company is financially healthy. It's a way for the company to say, hey, we're doing well, and we want to share our success with you. It's also a way for companies to attract long-term investors. People who like dividends tend to be patient. They're not in it for the quick gains, they're in it for the steady stream of income that dividends provide. And when companies attract long-term investors, they get more stability in their stock price. But here's the thing. Not all companies pay dividends, and that's okay. Some companies, especially younger ones, would rather reinvest all their profits into growing the business. Think of companies like Amazon or Tesla. They've historically avoided paying dividends because they're focused on expanding their reach, innovating, and growing their market share. On the other hand, mature companies that are already well established, think about businesses like Procter & Gamble or Verizon, are more likely to pay dividends. They've already grown to a point where they don't need to reinvest every penny, so they can afford to reward their shareholders. Now let's talk about the types of dividends. The most common type is a cash dividend. This is exactly what it sounds like. The company gives you cold, hard cash, usually deposited straight into your brokerage account. But not all dividends come in the form of cash. Some companies pay a stock dividend. Instead of giving you cash, they give you more shares of stock. This is less common, but it's a nice way to increase your ownership in the company without having to buy more shares. There's also something called a special dividend. These are one-time payments that companies make when they have extra profits they want to distribute. Special dividends are usually larger than regular dividends, but they're not something you can count on happening regularly. Another important concept is dividend growth. This is a percentage that tells you how much you're earning in dividends compared to the price of the stock. Let's say a stock is trading at $100 per share and the company pays a $5 annual dividend. That means the dividend yield is 5%. Dividend yield is a quick way to gauge how much return you're getting from your investment. But it's important to look at more than just the yield. A stock with a super high dividend yield might be risky. It could mean the company is struggling and trying to lure investors in with a high payout. Always consider the company's financial health and whether the dividend is sustainable. A steady, reliable dividend is usually better than one that looks too good to be true. So, why do dividends matter to you as an investor? Dividends are one of the most reliable ways to generate passive income. Whether you're reinvesting those dividends to grow your portfolio or using them to cover living expenses, they provide a consistent stream of cash flow. And here's the kicker. Dividends can help smooth out the ups and downs of the stock market. Even when stock prices are falling, dividend payments can provide a cushion. In fact, during tough times, some dividend-paying companies still maintain or even increase their dividends, which can be a huge boost to your overall returns. Over the long run, dividends have accounted for a significant portion of the stock market's total returns. That's because they don't just give you income, they can also be reinvested to supercharge your portfolio's growth. Now, you might be wondering, how do I find the best dividend stocks? That's a great question. And it's important to approach this carefully. Just because a company pays dividends doesn't mean it's automatically a good investment. You want to find companies that have a history of not only paying dividends, but also growing them. Here are a few practical tips for identifying strong dividend-paying stocks. Check the dividend history. Look for companies that have consistently paid and increased their dividends over a long period of time. A company that has raised its dividend for 10, 20, or even 50 years is often a good sign that the company is financially stable. Look at the payout ratio. This is the percentage of the company's earnings that are paid out as dividends. A payout ratio that's too high, like above 80%, could be a red flag. It might mean the company is paying out more than it should, and the dividend could be unsustainable. A payout ratio in the 40% to 60% range is often a sweet spot. Assess the company's financial health. Even if a company is paying dividends, you still want to check its financial fundamentals. Are they profitable? Do they have a healthy balance sheet? If a company is struggling financially, they might cut or suspend their dividend during tough times. Watch out for high-yield traps. Sometimes a stock will have a very high dividend yield, but that could be a sign the company's stock price is in free fall. Always do your research to make sure the high yield is sustainable and not masking deeper issues with the company. Finding great dividend stocks is a bit like being a detective. You've got to do your research and uncover which companies are truly committed to rewarding their shareholders over the long term. Dividends might not be the flashiest part of investing, but they're one of the most dependable. They're the paycheck that keeps coming, no matter what the market is doing. By understanding dividends and how they work, you can start building a portfolio that grows and pays you for years to come. To sum it up, dividends are more than just a payout. They're a tool that can help you grow wealth, generate passive income, and stay disciplined as an investor. They connect you directly to the success of the companies you invest in and reward you over time for sticking with your strategy. So whether you're just starting your investing journey or you're looking to add some stability to your portfolio, dividends could be the key to unlocking long-term wealth. And the best part? You don't need to be a financial expert to start. Just keep learning, keep investing, and let those dividends do the work for you.